Hi friends, today's session is about various accounting principles or conventions. Accounting conventions means the common practices which are universally followed in recording and presenting business transaction in an effective manner. The various accounting conventions or principles are dual aspect principle, historical cost principle, verifiability and objectivity principle, revenue recognition principle, matching principle and full disclosure principle. Dual aspect principle. As per this principle, every transaction has two aspects, receiving aspect and giving aspect. Receiving aspect of a transaction is called debit and giving aspect of a transaction is called credit. For example, Mr. Tom purchases machinery for rupees 2 lakhs. Here, the two aspects are purchasing machinery and paying cash. From business point of view, the receiving aspect is machinery and giving aspect is cash. So, machinery will be debited and cash will be credited. This principle gives the accounting equation assets equal to liabilities plus capital. This means all assets of the business are either provided from the funds of the owner or outsider. For example, Mr. Tom purchases goods worth rupees 1 lakh from Mr. Kumar on credit. In this example, asset increased. We have to find out whether this is due to owner's fund or outsider's fund. Kumar is an outsider, so liability increases. The system of recording transaction with its dual aspect is called double entry system. Historical cost principle. This principle states that all fixed assets are to be recorded at their cost price less decrease in the value, which is called depreciation, irrespective of its current market value. For example, the acquired cost of machinery was rupees 2 lakhs and its current market value is rupees 10 lakhs. The value of machinery that will be shown in the financial statement is its acquired cost, that is 2 lakhs less depreciation. Verifiability and objectivity principle. Every business transaction must be based and supported by documentary evidences or source documents such as bills, vouchers, etc. Revenue recognition principle. Revenue is the amount which a business earns through the sale of goods or services. Revenue is recorded at the time when the title of goods passes from the seller to the buyer. For example, Mr. Tom received an order on 1st June 2018 to supply goods worth rupees 20,000. They supplied ornaments on 15th June and the payment received on 25th June. The question is that when the revenue will be realized. Is it on 1st June, 15th June or 25th June? As per this principle, the revenue is recognized at the time when the goods or services were actually delivered, that is on 15th June 2018. Matching principle. This principle states that measure all expenses incurred during the period and match the expenses against the revenues earned during the same period. To get net profit or loss, subtract expenses incurred during one period from revenues earned during that same period. Full disclosure principle. Circumstances and events that make a difference to financial statement that should be disclosed as notes and supplementary to the financial statements. Examples of such events include significant tax disputes, modifying depreciation schedules or unusual events like flood. Let us revise the session. The various accounting principles are dual aspect principle, historical cost principle, verifiability and objectivity principle, revenue recognition principle, matching principle and full disclosure principle. Hope you clear with the concept. Thank you.